Most business owners that I meet aren't struggling because they're doing anything wrong. In fact, most of the owners who end up on a call with us are incredibly capable operators. They know their craft, they really know their customers, and they built something real with their own hands. The real issue, the one nobody teaches you how to solve, is that most business owners are trying to grow on a financial foundation that's stretched far too thin for the weight they're placing on it. Not failing, not broken, just stretched. And when the foundation is stretched, everything above it starts to feel heavier than it should. You've probably felt this yourself. You land a project you're excited about. You've got your crew scheduled, the materials lined up, the plans in motion, but the job doesn't pay until weeks or months down the road until it's done. Meanwhile, payroll hits every Friday like clockwork. Suppliers want payment up front. Fuel costs come out immediately. So you do what almost every business owner does in that moment. You grab the only funding option that moves quickly, and that's a short-term loan, a merchant cash advance. Sky-high fees on most of them, high payments, but really fast and convenient access. It solves the immediate problem, but the cost shows up later in the form of daily withdrawals, weekly payments, and that pit in your stomach every morning when you check your bank account, not for growth, but for damage control. But here's the part that most business owners never realize. There is a long-term, accessible, stable, government-backed funding tool designed specifically to help small business owners grow and given out by the Small Business Administration. These loans give business owners the breathing room, predictability, and financial cushion they deserve to grow their operation. It's the SBA 7A loan. Most people have heard of it, but very few understand how it really works or how powerful it becomes when you prepare for it and time it correctly. When used strategically, the SBA 7A, it doesn't just give you funding, it gives you a foundation. So let's break it down clearly, simply, and in a way that actually applies to your business. Think of the SBA 7A loan as the reinforced concrete slab under a major build. You don't think about it every day, but everything is smoother, steadier, and safer when it's there. The SBA doesn't loan you money directly. Private lenders do. SBA approved lenders, SBA approved banks do. But the SBA guarantees up to 85% of that loan. And when a lender has that kind of guarantee behind them, they're able to give you exceptional terms. Longer repayment periods, lower interest rates, higher approval amounts, broad flexibility in how the funds are used. You can borrow up to $5 million. You could use it for working capital, equipment, real estate, refinancing expensive debt, buying a business, buying out a partner, expanding into a second location, stabilizing cash flow, upgrading your fleet, growth initiatives of almost any kind. So you're probably asking yourself, if the SBA 7A loan is that powerful, Zach, why aren't more business owners using it? There are two main reasons. Most people don't know how to prepare for one, and the other reason is most people don't know when to apply. Let's start with preparation, because this alone puts you way ahead of the majority of applicants. SBA lenders are going to evaluate your application based on three key pillars. These are the steel rebar inside your foundation. Strengthen these and everything becomes easier. Pillar 1, credit. Your personal FICO score matters, not because lenders expect perfection. They don't. Because your credit score tells a story about how you manage your obligations. A 650 score is often enough to start a conversation. A 690 plus puts you in a much stronger tier, and 750 plus puts you in the A tier. Even though it's a business loan, improving your personal credit is improving how your business looks on paper to these underwriters. It's tightening bolts before the inspection. Pillar 2, cash flow. Measure the DSCR, debt service coverage ratio. Sounds complicated, I know. It's not. It's just comparing how much profit your business generates to how much debt you need to pay back and whether or not you can afford to make the payments. A DSCR of 1.25 means your business earns $1.25 for every $1 in debt obligations. That extra quarter is the bank's cushion. It's their breathing room. A pest control company that we helped recently came in at a 1.16 DSCR to the amount that they wanted. Almost there, but not quite. Through some small refinements, adjusting pricing on 2 of their service tiers, renegotiating supplier terms, and cleaning up their bookkeeping, they improved to a 1.27 in under 45 days. The business didn't change. The presentation is what changed, and lenders immediately took them a lot more seriously. Pillar 3, eligibility and character. This is not a personality test. The SBA simply wants to confirm that you're a real operating business in the US, you're for profit, you've invested time and money into the company, you have your financial documentation in order, and you genuinely need affordable funding. If you're running a real company, it's easy to check all these boxes. And when all 3 pillars line up, credit, cash flow, and eligibility, the SBA becomes your single strongest financial tool available on the marketplace. Now let's talk timing, because this is the part most people are unaware of. And it's the reason the next 18 months matter so much to anybody watching this video. We're entering one of the strongest SBA funding windows that we've seen in years. Here's why. Reason number 1, falling interest rates. Economists expect rate cuts through late 2025 and 2026. The SBA cuts how much interest lenders can charge, and that cap is tied to the prime rate. When the Fed cuts rates, prime drops. When prime drops, your potential SBA rate drops with it. If you could find a bank that has fixed interest rates, imagine locking in a lower rate for up to 25 years. It's like securing tomorrow's cheaper money today. Reason number 2, a major temporary policy advantage. For the entire 2026 fiscal year, October 1st, 2025 through September 30th, 2026, the SBA is waiving upfront guarantee fees for small manufacturers on loans under $950,000. That's real savings, thousands of dollars, a tailwind for those who qualify. And they are also raising the limit on what qualified manufacturers can borrow. Manufacturers can now borrow up to $10 million through SBA approved lenders. Reason number 3, the largest wave of business owner retirements in US history. It's called the Silver Tsunami. Baby boomer owners are stepping out of their companies. Many of these businesses are profitable, stable, and built on 20 to 40 years of relationships. The SBA business acquisition loan is specifically designed to finance acquisitions like these. One of our clients recently acquired a specialty metal fabrication shop from a retiring owner. Long-standing customers, strong contracts, solid margins. The SBA 7A program for acquiring businesses gave him the ability to take over the business with a 10-year repayment schedule and predictable, manageable payments. He didn't just expand his growth, he stepped into a legacy. Now, let me address something directly, because almost every experienced business owner thinks this before they apply. I don't think I'd qualify. We hear this constantly, and almost every time, once we review their numbers, they realize they're much closer than they imagine. It's rarely a major overhaul that's needed. Most owners just need small adjustments, tightening up their books, building some business credit, improving DSCR, cleaning up their personal credit, or restructuring shorter-term debt. Once the foundation is strong, everything above it gets lighter. Imagine running your business without the constant fear of cash flow gaps. Imagine payroll not being a weekly stress point for you. Imagine being able to accept growth opportunities without worrying how you'll float the early cost. Imagine planning next quarter instead of just next week. That's what real stability feels like, and that's what the SBA 7A is designed to provide. If you want to understand exactly where you stand, your credit strength, your DSCR, how lenders will view your financials, and your best strategic timing, use the links below this video. This is not a sales pitch, it's a strategy session. We'll walk through your numbers with you. We'll explain exactly how lenders interpret them, and we'll outline the steps to put you in the strongest possible position for funding in 2026. Set your foundation before you scale, because when the foundation is solid, everything above it becomes easier. Let's build that foundation together.